Hello and welcome. Lean finance is the application of lean management principles to the finance functions and related processes within an organization. Lean finance practices aim to enhance value for both customers and stakeholders by streamlining financial activities, by eliminating waste, and by ensuring that the organization's continuous improvement efforts deliver concrete financial benefits. Specifically, there are 7 areas that financial leaders must study in order to fulfill these aims. Financial leaders play a key role in ensuring the success of continuous improvement efforts. Lean, Six Sigma, and other methods unlock the potential of people and processes, contributing significantly to profit. The first 3 areas deal directly with this question. This begins with being able to validate or make the connection between lean efforts and their financial impact. This requires that financial leaders are familiar with lean methods and how they deliver savings. Specifically, this involves being able to identify how process improvements result in reductions to the cost of goods sold, or COGS. In addition to reducing costs, lean efforts can also contribute to increasing revenue by freeing up capacity, and this contributes to improved gross margins. Lean practices often deliver positive financial impact to the balance sheet. As processes become more streamlined, efficient, and reliable, this can reduce the need for property, plant, and equipment. It can also free cash that's tied up as inventory and reduce the need for borrowing. But first, there's often a negative impact on the balance sheet as assets are reduced. Traditional financial measurement, reporting, budgeting, forecasting, and planning processes can often be obstacles to realizing the full benefits of lean methods. That's why the second area is unlocking the financial impact of lean by understanding the situations and reasons why financial results may be invisible, lagging, or missing. There are various reasons why the impact of lean efforts may not be seen in the financial reports immediately or at all. This may include failing to agree up front on what to measure and how, improvements being too localized, errors or delays in collecting data, and other reasons. We may fail to see the results of lean in financial statements because the savings are indirect, meaning we must fulfill one or more additional conditions before we can unlock the benefit. This requires being familiar with and knowing how to account for both hard savings that are directly visible in the financial statements and indirect or soft savings that are less tangible but often strategically important. However, there are also long-standing accounting norms, standards, and practices that not only fail to show the benefits of lean, but can falsely suggest that financial performance is getting worse as processes improve. That's why the third area for financial leaders to study is the differences between traditional and lean accounting. For example, financial leaders must be able to show the positive impact of reduced inventory levels on financial statements. This is because lean methods often reduce work in process and increase inventory turns, but traditional accounting may not show this as a benefit. In addition, lean accounting gives us a way to allocate costs to specific value streams instead of products or departments. This means measuring performance based on the entire chain of process or value stream, rather than individual processes, products, or isolated departments. Managing and measuring work in terms of value streams is essential for capturing the benefits from lean related to speed and flow. Exactly what areas of our accounting system we must adapt or enhance to better support continuous improvement will depend on the type of business and our reporting requirements. These may include learning how to transition from absorption costing to value stream costing, simplifying reporting and transitions, and providing more relevant and timely information to support operational and strategic decisions. The fourth area for financial leaders to study is the topic of lean budgeting and forecasting. Traditional budgeting and forecasting can be long, complex, inaccurate, and inflexible to future changes. In contrast, lean budgeting and forecasting aims to streamline the process, create budgets based on value streams rather than departments or projects, and use a rolling forecast. In traditional budgeting, the goal may be oversight and control of spending. Lean budgets ideally allow us to identify the financial movements necessary to achieve our desired strategic changes. Lean budgeting and forecasting enables this through accuracy, flexibility, and adaptability, while encouraging decentralized decision-making and agility. The fifth area is to support these lean finance practices by streamlining and simplifying our processes. Because finance touches on all parts of an organization, financial leaders have many opportunities to get involved and support various lean efforts. This may require adapting their processes to fit the needs of the organization. There are many proven approaches for mapping our processes, identifying value, removing waste, and freeing up the time of finance professionals to shift from reporting to analysis and advisory work. A good place to start is to identify complex, time-consuming, or error-prone processes and bring together a small team to rapidly redesign the work. The sixth area is the ability to make better strategic finance decisions. Perhaps the most important aspect of lean finance is that it allows us to shift our focus from past-oriented reporting to future-oriented and more strategic finance activities. There are 4 common ways we can leverage lean to make strategic finance decisions. The first way involves cash flow management. Lean financial management requires being able to leverage the positive impacts of reduced inventory and shorter lead times on cash flow. Improved cash flow as a result of lean practices has significant implications on working capital requirements. The second way is through capital investment decisions. Financial leaders have the opportunity to plan ahead and investigate how lean practices can influence capital expenditure decisions. Lean methods often allow smaller, simpler, incremental, and more flexible processes and equipment, enabling a different approach to capital expenditure. The third way is target costing. This involves understanding how to derive a product's selling price based on customer expectations and desired profit margins, and then working backwards to determine allowable production costs. Finally, the fourth way is through product pricing. Financial leaders may find opportunities to influence pricing strategies by understanding how lean affects cost structures. Specifically, as lean reduces costs, we may find our products are competitive in new niches. Also, lean practices often enable us to practice value-based pricing through differentiation based on flexibility, speed, or mass customization. As we can see, lean finance has a broad scope that encompasses the entire finance function of an organization. This includes budgeting, forecasting, financial analysis, cost control, corporate finance, lean accounting, and more. However, we can't do everything at once. That's why the seventh area for financial leaders is to embrace continuous improvement as a long-term effort. This requires that we take a long-term approach, setting our sights on the areas where applying lean principles to finance functions will have the most impact. We can start by doing a self-evaluation of our current state, gaps, and opportunities in the various lean finance focal areas and their subtopics. This will help us to prioritize our efforts and define first steps. By studying and adopting sensible lean finance practices, leaders can align their long-term strategies and financial goals with lean management efforts. This ensures that the organization's lean journey is supported and enhanced by sound financial decision-making. That wraps up our review of getting started with lean finance. We'll see you next time.